Hi everyone, welcome to today's video. So on today's video, I'm going to speak about when you should not be buying stocks, especially in bulk. Why is this important for you to understand right now? Because the markets are exhibiting greed right now and a lot of people have started to re-enter the market thinking that, you know what, it's a forever bull run, etc, etc. So I thought that I would shoot a simple video explaining in very easy to understand language when you should not be buying stocks and is right now a good time to buy the stocks or not. So let me start the story by taking you to the Nifty 50 chart, and here what you would notice is that from 2020 and roughly 2021 mid, the markets were in an uptrend and it was sort of a mini bull run and the markets made a lot of gains. And after that, the markets have moved sideways for the last several months. And now what has started happening is that it has started to come back up and people are getting extremely greedy in this zone. So important point for you to understand, especially if you are a beginner or an intermediate player in the stock market, should you be doing bulk investing in this type of a market? Two very important set of commentaries here. So the first comes from Mr. Ramdev Agrawal, and here if you would read some of his news clippings, his commentary, what he simply says is that, you know what, I'm always invested in the market. And that type of strategy might work great for him. On the flip side, you will have commentators like Mr. Michael Burry, who will keep on saying that, you know what, I never invest in the market and you should also never invest in the market. There is just too much negativity, etc, etc. So as a retail investor, if you believe in either of these narratives, it could prove to be dangerous. I'm not trying to contradict these big investors. I'm simply trying to tell you that like these big investors also, you must understand why you are taking positions in the market. A great way of understanding this point is by looking at Mr. Ramesh Dhamani's portfolio. He's one of India's biggest investors. And what you will notice is that back in 2020, he started increasing his portfolio. So this was a time when markets were generally very pessimistic. So he increased his portfolio size. After that, he decreased his portfolio size. Why? Because there was a lot of greed in the market. And the third part of the story is that right now he is increasing holdings in different stocks and he's increasing his portfolio size. So my perspective as a retail investor is that I'm more aligned to Mr. Ramesh Dhamani's viewpoint of decreasing your portfolio size, booking profits, all this different stuff. This is very, very important because if you simply buy and forget, then again, you can make a lot of losses. And if you just simply keep following whatever everyone else is doing in the market, that, hey, you know what, a lot of panic, you will never buy. And if everyone is buying now, I will also start buying. Then the chances are that you will get stuck in really bad stocks and you will not be able to come out. So let me start discussing 7 key important points as to why you should not be investing in stocks. Reason number 1 is that you do not know or understand why you are buying a particular stock. So classic case in point would be the story of Tata Motors. So let me show you the run-up of Tata Motors first. And here you can clearly observe that the stock gave a massive run-up during this phase. And everyone was saying good things about Tata Motors, that, you know what, Tata Motors is the next multi-bagger, this, that, and people made money also. Why did they invest? Because they were playing the EV news, that Tata Motors is getting into the EV segment. It is a market leader. No other company in India is taking massive bets when it comes to EV segment. So let's buy Tata Motors. And those people made money. Why? Because their hypothesis means that their observation about the market turned out to be true. So they made money. At least they have an understanding as to why they were buying Tata Motors here, right? Now, I did not invest in this rally, but I had been saying for the last approximately 8-10 months, and you can check some of my videos here, that hey, Tata Motors has already given a run up. Why it has given a run up? Because of the EV story. Now, if you're sitting here and then you are deciding that, you know what, I'm going to buy Tata Motors now, you must have an understanding as to why you are buying Tata Motors here. Again, I get a lot of queries around Tata Motors that, Akshat, Tata Motors, is it a good stock or a bad stock? And should I be considering buying it? So I ask a counter question that, okay, why do you want to buy Tata Motors? What is the future that you are seeing? So people say that, you know what, okay, EV story again. But see, EV story has been factored here. So why are you sitting here and making a decision that Tata Motor will go up? Something else needs to play out, right? So please understand the reason why you are purchasing certain stocks. If you do not understand why you are purchasing a certain stock, please do not buy it. Now, the second key related reason is that people do not understand macroeconomics at all. Let me explain that by picking a simple example of bond investing and stock investing. Now, basically what happens is that when the riskiness in the economy is high, people should move towards bond. Why? Because of the simple reason that, hey, stock markets are slightly more riskier compared to bond markets. And therefore, you would have also seen that something like gold gives very good returns during riskier times. So if you plot the risk reward curve, you will see that gold probably the least riskiest, then come bonds, then come equities. Now, people do not understand when they should be switching between equity markets and bond market. Now, let me explain you about the bond market in very easy to understand language. So what you need to know is that bond investing is what? It is investing in fixed deposits, corporate corporate bonds, government bonds. So this is called as bond investing. Now, when should you invest in bonds? Basically, for that, you need to understand this equation. It says that the interest rate is inversely proportional to the price of the bond. For example, when the interest rate is high, the price of the bond will go down. If the interest rates are low, then the price of the bond will go high. So you can understand this point by picking a very simple example. And the example would be that last year, no one wanted to invest in FDs. Why? Because the interest rates were very, very low. Or what you can say is that the price of the fixed deposit was high. So if the interest rates are low or prices are high, then you should not invest in fixed deposits. So this is the basic equation. But the mistake that people make is that they look at the current interest rate or current inflation, etc., and they make decision. What is important here is the expectation of interest rate. If the expectation of the interest rate is that 6 months from now, the interest rates will be higher than what it is today, then you will get the bonds right now at a slightly lower price. So you should purchase something which is available at a low price right now, then sell it off 6 months after. So right now you must ask yourself a very simple question that, hey, do I see the interest rate going higher from this point or no? If your answer is yes, then you should consider taking some positions in bond. And for that, you can check Golden Pie. It is India's #1 bond investing platform. You can go on the platform and scout as per your requirements of a bond. For example, if you want slightly safer bonds to invest in, then you should buy secured or collateralized bond. I had done a separate video. You can go check it there. So depending on the macroeconomic environments, you should pick between bonds and stocks. Now, just a very quick note, you should not be 100% stocks or 100% bonds. You can split it out as per your risk appetite. Now, the second key reason why you should not be purchasing stock is that if you don't understand the difference between trading and investing. Trading simply means that you're taking short-term bets or mid-term bets in the market. It can range from few hours to few weeks, and you are trying to flip a stock. So you do not care much about the underlying asset quality. So let's say that you identify a small cap, highly dangerous stock. What is the goal as a trader? The goal is to buy low and sell high, and you are just trying to flip that stock. You don't have a massive holding period and you're not considering the underlying asset quality. On the flip side, investing requires you to study the stock, look at the business prospects. A classic case in point is Zomato right now. So for example, if you feel that, you know what, Zomato stock is going to survive for the next 5 years, then probably you should go and study that stock. Now, if it fits your criteria of investing, you should invest. But please understand that when you are investing in that stock, you are not trying to flip the stock in 3 months, 2 months, 6 months. You just are concerned about the fundamentals or the business view of the stock. If the business starts doing poorly, then you exit the stock by booking a loss. If the business continues to do well, then you will hold the stock. Many a times we wonder that how a big investor purchased some stock 30 years ago and are still continuing to hold it. Why? Because they are not trading in that stock. They have invested in that stock and they continue to analyze the business prospects of the stock. So please understand whether you are a trader or an investor, both the things are not similar. Now, the third reason why you should not be investing in the stock is that if at this stage in your career, you don't have enough capital. So let's assume that you're 17, 18 years old. You are in college right now. You are only investing, let's say 1,000, 2,000 rupee in the stock market. Even if you make 100% returns in a year, but your initial capital is only 2,000, it grows to 4,000 by the end of the year. So your focus at that juncture in your career should not be to purchase stocks or learn more about bond investing. What you should simply do is that please improve your earning potential first. Please understand the difference between absolute returns and percentage return. So percentage return could be 100, but your initial capital, if it is very, very small to begin with, it is pretty much pointless. But on the flip side, if you have big capital, let's say that you are investing 10 lakh rupees and you are able to generate 15% profit, then you will be making 1.5 lakh rupees. Of course, tax is separate, but I hope you get the message that at certain stage in your life, you should not be too bothered about stock investing also. Now, point number 4 is that if you don't know when you are looking to exit that stock, then probably buying that stock also does not make sense. Okay, so let me explain this by using the example of ITC. For example, I purchased ITC somewhere at around 180, 200 levels and I sold it somewhere around 280, 285 levels. Now, why did I sell it at approximately 280, 290 levels? The reason was very simple, that there was a very clear cup with handle pattern that was getting formed and the technicals were telling me to sell that stock. So I sold that stock. Now, was I right about it? The answer right now looks like that I was not right about it, simply because of the fact that the stock has given further run up on that front. The important point to note is that I had a very specific exit plan and I executed that plan. Now, what you must remember is that no investor in the world can predict the exact bottom or exact top of any stock. For example, it might very well happen that ITC runs up to 800 rupees. I don't know. But the technicals were telling me to sell it. Therefore, I sold it. At least I had an exit plan. Otherwise, what usually happens is that retail investors would purchase a stock. They will just continue to hold it forever. That stock keeps on dancing. And even when you get opportunities to sell that stock, you would not sell it. So whatever your rational analysis tells you, it could be as per fundamentals or technicals or business analysis, you must execute that plan. Then comes point number 5, that if you don't know how to rotate your capital in the stock market, then probably it might not make sense for you to become a stock market investor in the first place. Now, what is meant by rotating the capital? Again, building on from the ITC example, that okay, great, I sold ITC. What did I do with that money? Because if you book profit and you keep that money under your pillow, your money will not grow. You will have to reinvest it somewhere. So that is called as reinvestment risk. And in order to manage your reinvesting risk, you must understand how to rotate your capital. So for example, when I sold ITC, I rotated a large part of that money into something like TCS. Now, this is not an advice for me that you go and purchase TCS too. Now, why did I do that? Simply because of the point that I purchased ITC when FMCG sector was beaten down. So I got it at a good price. And when did I sell ITC? When FMCG stocks were running up. So I sold it, book profit, made money. Now that money I put it into IT. At this juncture also, IT and tech companies are badly beaten down. So I have identified some undervalued sector, so to say, and I've put some money in it. Now will it go up? Will it not go up? I don't know, but I'm just playing the risk reward equation. So as a sensible investor, if you don't know how to do that risk reward analysis, then probably investing directly in stocks might not make sense for you. Now, point number 6 is that many a time people are super impatient when it comes to even good stocks. A classic case in point is Hindustan Unilever. I had been making so many videos on Hindustan Unilever on my channel over the last 6-7 months. In fact, at one point, people were saying that, hey, why do you keep talking about HUL on every single video? Go back 6 months and look at my videos. And let me show you the performance of Hindustan Unilever over the last 6 months. So here you will notice 13.4. But this was the zone around 2000 when I had made a lot of videos on Hindustan Unilever. So if you would have done bulk purchasing of stocks somewhere here, you would be sitting on a massive profit on a blue chip company. So that is the point. But what people assume is that, hey, here, good opportunity to buy Hindustan Unilever, I will buy it. But unfortunately, if it falls, then I will panic. So that should not be the case. If you are purchasing some good stock, if you understand why you are purchasing that stock, and if you have belief that a company like Hindustan Unilever, it will not forever keep on falling. It will rise back up. You must understand all these basic points, understand why a particular stock is going down. For example, one of the primary reason for the fall of Hindustan Unilever stock was that, hey, inflation problem and HUL will not be able to deal with it. People with no buying power will not be able to buy HUL products, etc., etc. All those things have been thrown away now. And HUL has given very good run up. Now people are debating, should we be buying Hindustan Unilever here? You tell me in the comment box, should you be doing, should you not be doing? This brings us to the final point, that if you can't handle stock market volatility, individual stock purchases is not a place for you. Please do not invest in stocks. Let me show you a very recent study. This is a study that was done over a period of 9 years, from 2009 to 2019. Now take a look at volatility as to how many times the market fell more than 10%. So the market fell how many times? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 times it has fallen by more than 10% in a period of 10 years. Now people start panicking whenever the market falls by even 2%. So this message is very important, that in the next 10 years also, the markets are going to fall by more than 10%, at least 14-15 times. So please do not panic during those times. And if you're not investing during such occasions, you will not be making money in individual stocks. I hope you enjoyed this video and it gave you a little bit of perspective as to when you should be buying stocks versus not buying stocks, and when you should be doing bulk purchasing versus not. Thank you so much for watching, and I will see you soon.